I'm Charlotte McLeod with the Investing News Network, and here today with me is Ed Moy, Chief Market Strategist at Valaurum and former Director of the US Mint. Thank you so much for being here online with me today.
Charlotte, really good to be with you. And with that great introduction, I need to remind you I'm no longer director of the Mint. Otherwise, I give you a free sample.
I wish that would be possible. So let's jump into our questions. Speaking about your time at the US Mint, you were there during a very interesting time from 2006 to 2011. Very interesting time for gold. The metal rose quite substantially over those years and hit its previous all-time high in 2011. And more recently, we've seen gold more or less on the rise from 2016 to its new all-time high, which came last summer of over $2,000. To start us off, I wondered if you can tell me if you can draw any parallels between those time frames and perhaps what that can tell us about gold right now.
I'm happy to, Charlotte. First of all, both times, both during the financial crisis and now during the economic crisis caused by the COVID pandemic, gold rose immediately. And so you saw an immediate pop. And then in both situations, then gold took a break. And then you saw gold steadily climb to new highs. And I think you're going to see roughly a similar pattern, maybe in a compressed time frame this time around. Economic crises were the catalyst for gold rising in the first place. And then there was a pause taken because the government took very aggressive action to try to address the economic consequences of those crises. But the government intervention didn't take hold right away. And it caused a lot of uncertainty and risk for inflation. And it took, in the case of the financial crisis, which happened from 2007 to 2008, the gold price didn't peak to 2011. And the gold price peaked and then started falling when it was commonly accepted that the economy was going to grow pretty slow. And that eliminated the uncertainty around the economic recovery. And it was also going to recover with very low risk of inflation. It wasn't even meeting the Federal Reserve's 2% inflation inflation target. And so as a result, when those two things became firm in investors' minds, the price of gold started dropping. And I think we're going to see the same thing here. The other interesting thing I'd point out is I was Mint director during the time of the financial crisis. And one of the challenges that we had during that time was one of the Mint's products, which is precious metal bullion, its demand skyrocketed. It skyrocketed 700% for gold and 450% for silver. And we're seeing the impact of that now during the COVID economic crisis. We've seen gold demand shoot up. The United States Mint had its best first quarter ever in history on gold bullion. So much to the point where the US Mint has had problems meeting that demand.
Certainly a lot on right now, and we're going to jump into some of those factors.
Yeah.
But first, if you could narrow down for us, when you look at the situation today, what are the most important factors that you see for gold at the moment?
Mm-hmm. Yeah, so gold prices, when you look at long-term fundamentals, are really driven by the risk of inflation. And the reason why gold responds to inflation is gold is an alternative asset. So when the dollar goes down, gold prices usually go up. And so the risk of inflation in the near, mid, and long term today are very substantial. We've seen a dramatic increase in the money supply. So when you look at M2, which basically captures all the money in circulation for US dollars, we've seen a 25% increase since before the pandemic. Now, let me put that in perspective. That 25% increase in the money supply is bigger than the increase during the financial crisis, during World War II, during the Depression, during World War I and the Civil War. It's the largest growth in US money supply in our entire history. And the only reason why we're not seeing inflation is the other part of inflation besides the money supply is the velocity of money, how often that one piece of currency is used. And right now the velocity is very low. So risk of inflation is one of the most important drivers, but the other one too is uncertainty over how the economy will recover. And here we have two competing views. We have the private sector who thinks there's going to be a robust recovery, and you're seeing that with rapidly rising bond yields. So money is more expensive to borrow now because when you have to pay it off later, they expect the dollar to have suffered from some inflation. Versus the government, the Fed Chair Powell recently said, which is consistent with Treasury Secretary Yellen and the Biden White House, basically saying, you know what, doing too little is a worse problem to have than doing too much. And so they've gone into stimulus overdrive, which has contributed to this huge increase in the money supply. So until the risk of inflation is significantly reduced, and until there's more clarity over how the economy will recover, right now, both those factors are playing well for gold in the long term.
Right. And let's maybe put this together in terms of what it could mean for the gold price, because I know a lot of people are a little disappointed to see gold come off from the all-time high last summer. So where do you see gold going in 2021 and perhaps in the longer term if you have a view that far?
Yes. So, I have the benefit of having experience during a financial crisis and then watching the pattern of gold, and I see some similar patterns. And with that, I'm not at all surprised that gold has taken a little bit of a break. But I do think that gold will end up somewhere between $2,000 and $2,100 by the end of this year. And the reason why I make that argument is, as you've pointed out, Charlotte, there's a big disconnect between the price of gold and the demand for physical gold right now. Price of gold, as you noted, has lowered, from its high of almost 2,000 down to 1,780 today. But yet demand is through the roof for physical gold. And so the Perth Mint in Australia, the United States Mint, the Royal Canadian Mint, the South African Mint have all reported huge, robust sales in the first quarter. And they've also, like in the case of the United States Mint, reported that they cannot manufacture enough gold bullion coins to meet demand. And so when you look at that and what people are actually willing to pay for when you can find those gold bullion coins in the market, you're seeing a 10 to 20% premium being paid over the spot price of gold. Now, that's not everywhere, but when you look at the top 10 gold retailers, they're selling their gold eagles, around 1 ounce gold eagles, for between $2,000 and $2,100. So even though the spot price is well below that, to me, the real price of gold is what the market is willing to pay for it, and they're willing to pay up to $2,100. Now, that's why I'm making the prediction that by the end of this year, I think $2,100 gold in the spot price is a very realistic and reasonable forecast.
Right. That's a great way to explain it. I want to go back to this really high gold demand and also demand for physical silver that we've been seeing over the last little while. You spoke about how the mints are seeing such huge demand from investors. Can you go into a little bit more detail on what that actually means? Because we've started to hear things about mints, perhaps not being able to meet that demand. So,
Mhm.
what does it mean when all of this is happening? Is it a supply chain issue? Is it simply that the right size or type of the metal is not available? What does it actually mean?
Mhm. Very good question, Charlotte. And for some of your viewers who may not be familiar, government mints are mints because we have the ability by our constitutions to actually make money. And so our value added is taking a piece of paper or a piece of metal, and at the end of our manufacturing process, it becomes legal tender. And so mints end up making bullion coins, and they're called coins because a government mint makes them and it has to denominate them. So our 1 ounce coin, gold, our 1 ounce gold eagle has $1,788 worth of gold in it today, but it has a denomination of $50. And what that means is that you can spend it for $50, even though it has all that precious metal in it. And we denominate it lower than what its metal value is, because we want to force the owner and the receiver to be able to value it for its precious metal. And you can't denominate it to its precious metal content because of the fluctuating prices. So saying that, there are shortages in all the major mints right now due to high demand for these denominated bullion coins, both gold and silver. And part of that is just due to, the shortages are due to the high demand. But the other part is due to supply chain challenges. So I can't, when gold demand really went up under my tenure, I can't go to the local convenience store and buy gold planchets to stamp my coins on. It's a very specialized field with a very limited capacity. And so these, like the United States Mint, we buy from private companies who specialize in this. And in order for them to meet that increased demand, they have to hire more people, they have to spend more CapEx to expand their plant and to buy the equipment, etc. And so there's a lag time that's needed in order to increase their supply. But COVID also has exacerbated these supply chain challenges, because all the way up from the mining to the refining, to the making of planchets, to the companies that deliver the planchets to us, if you have someone sick or you have fewer employees, it starts disrupting the supply chain. And also at the United States Mint, even though I'm no longer the Mint director, there's been several incidents of COVID where we've had to shut down our manufacturing plants. And then it takes a while to warm the equipment up again and so on. And so though COVID has disrupted the normal, very fragile supply chain that supplies the global mints. Second is, when we get the gold, in the United States, we have a special challenge. And that's the legislation that authorized us to make gold bullion requires us to get gold or to have gold that's been actually mined and produced here in the United States. And so that adds an additional challenge to what we have. The last thing that I want to say about demand and supply is that for mints, it's more cost efficient for us to produce 1 ounce coins than it is to produce 1/10 of an ounce coins. And so when push comes to shove, mints end up deferring to doing the most cost efficient way of producing gold bullion or silver bullion. And so they produce it in 1 ounce amounts. And that's causing an issue, because whenever the mints are able to make smaller denominations, the mints are finding that there is growing market demand as gold prices go higher. So for example, the common person on the street, and probably you and I, Charlotte, we don't carry $2,000 in our pocket readily to buy a 1 ounce gold coin. It's something we have to plan for and save for. But it's a lot easier for us to buy a 1/10 of an ounce one at $200. And so what we're finding out that as gold prices rise, there's a greater demand for bullion in ever smaller amounts. And there are private sector makers like the company that I work with that are filling that niche for smaller amounts.
So you are at Valaurum, you're seeing this demand for the smaller amounts of gold. Can you go into that in a little bit more detail so we can get a sense of the demand?
Yeah, so we have the same issue as all the other mints do, and that is we have a backlog of orders that we have to fill, and so demand far outstrips the supply that we're able to put to the market. And just to give you a perspective, when I was at the mint, this is what we made. This is the global standard, even more than the Cougarand, for 1 ounce gold coins. And this is the American Eagle Gold 1 ounce coin. And as you see, when you have something like this, you have to have $2,000, $2,100 to buy it on a retail basis today. But what Valaurum has been able to do is with technology, we're able to break down gold into its atomic state and then reapply that gold onto any surface we want at a very precise layer. And so the problem is when you try to make smaller amounts of gold, and the smallest one the US Mint made was 1/10 of an ounce, you end up having a coin about the size of a penny. And if you make it any smaller than that, you can easily lose it. It's very hard to make with all the features that are on a coin. But if you take a look at this, this is a Valaurum note that has 1/10 of a gram of gold in it. All the gold color you see there is 100% solid gold at 24 karat purity. And 1/10 of a gram would be the equivalent of about a grain of sand. And so when you spread it out this thin, it is about 1/4 the width of a human hair being applied here. But we're able to do it in a very verifiable form, so that if you melted the 2 pieces of polymer sandwiching this, you would get exactly 1/10 of a gram, which is about $6 of the gold. Now, all of a sudden, gold becomes much more affordable to a greater number of people, and that's what's driving our demand.
That's really interesting, and I appreciate the examples that you had to show. So we've been talking a lot about gold, which is always great. I do want to throw in a question on silver, where we're
Mhm.
also seeing quite an interesting situation develop over the last few months. We've seen retail investors really snapping up physical silver, trying to create this silver squeeze and
Yeah.
push the price up.
Mhm.
I've heard a lot of different perspectives about whether it's actually possible to squeeze the silver price in that way by buying up physical metal. So I wanted to get your perspective on what's going on there.
Mhm. Yeah, very relevant question given what recently happened with the whole GameStop situation and Robinhood. When you look at that, uh, GameStop, they were able to put the squeeze on that and really shook up the market a bit. And GameStop's not a small company. It has a market cap of $12 billion. And then soon after that, these individual investors were looking for other targets that they thought they could put the squeeze on, and silver became one of their targets. But one of the things that happened was that plan was dropped pretty quickly. That was really a couple days story, and it was all over, and people got out of it. And here's the reason why. The total silver market cap, and I'm talking about all the silver that's ever been mined in the world versus all the GameStop stock added up together, which would be 12 billion. All the silver that's ever been mined in the world at today's prices would be $1.4 trillion. So that's 120 times a volume of what the GameStop market cap is. And it's a lot harder for a group of individual investors to capture the market and put the squeeze on silver. Plus, you have much more diverse use for silver. So not all that silver is used for investment purposes. So it's not as a consolidated place to get it all as the stock market is for an individual stock. You have industrial use, jewelry, electronics, derivatives, and people who, when I was at the Mint, when people bought 1 ounce of silver, our American Eagle silver, they would do the modern term for Bitcoin as hodl, which is hold on for dear life. When people generally buy a silver bullion, they hold on to it. And so there was just a lot less available, really only the derivatives that were available to these investors to try to corner the market. And that has such a small percentage of the overall market cap of silver. In retrospect, people looking at this could have figured out that they would have very little impact.
All right, well, thank you for that explanation. We've got so much going on in gold and silver. We've covered just a few of the things that are happening. One other point that's going on right now is amid all of this activity, there's a number of American states that are looking at introducing legislation related to recognizing gold and silver as legal tender.
Mhm.
So I wondered if you could help us put that into context as well by explaining how are they seen now and what is this legislation looking to change?
So in my world, which is money and gold, this is really a big deal, and it's getting not a lot of play outside of certain policy circles and what's going on in these states. So I'm really glad, Charlotte, that you brought this up, because I think a lot more attention needs to be placed on it. So saying that, this gets right back to the Constitution. So when the Constitution was written, money was the equivalent of precious metal. So it didn't matter if you had 1 ounce of silver that was made from Spain or from France or from England. 1 ounce of silver was 1 ounce of silver anywhere, and if you wanted a half a dollar or half that amount, you'd cut that coin in half, or quarters, which is how we get the fractional system that we refer to coins now these days. And what the Constitution ended up doing was the recognition by our founders that our country needed to be unified by a federal government, and that federal government had to have the authority to have control over our currency. And so they took that away from the states and consolidated it within the federal government, and that's how the mint was created, was from the Constitution. But what they left to the states to decide is whether or not to allow their citizens to settle their debts in gold and silver. You can find this in Article 1, Section 10 of the Constitution. So no state has ever exercised this since it was put into the Constitution until after the financial crisis. So I don't think it was a coincidence that states started considering this after 2008. And currently, there are 12 states that have implemented some form of state legislation that operationalizes Article 1, Section 10 of the Constitution. I'm not sure I can get all 12 out of memory, but West Virginia, Utah, Arizona, Oklahoma, Texas, Indiana, Louisiana, Tennessee, South Carolina, and I know there's a couple more in there. And what legislation, what's in the legislation that these states are passing in order to operationalize this part of the Constitution? There are really four parts, four different legislative aspects that have been implemented to some degree in all of these 12 states. One is that the state itself recognizes gold and silver as legal tender, meaning that people, as long as someone's willing to buy with it and someone willing to accept it, it is legal in order to have that exchange. So if two people voluntarily want to transact in gold and silver, that is a legal transaction. And so most of the legislation includes that piece. But there are two other common pieces that are associated with this. One is a sales tax exemption. So when you buy gold or silver now, states usually consider that buying a product, and as a result, assess some type of sales tax on it. But when you end up traveling Europe and exchanging dollars for euros, you're not being charged a sales tax for doing that. You may be charged an exchange fee, but there are no taxes because it's commonly considered money for money is not buying a product. And so these states have, some of them have exempted gold and silver sales from state sales tax. The other part of the taxation piece that's normally included in this is whether or not capital gains can be assessed at the time that you use gold. So say, for example, you buy gold for $1,000 and it's worth $2,000 today, and you spend $20 of it to buy something. Do you pay $10? Does $10 of that $20 purchase subject to a capital gains tax? And what these states are saying is, no, it shouldn't. Just as the dollar rises or devalues, you don't pay capital gains or take capital losses on every time your dollar fluctuates. You shouldn't be subject to the same when you're buying and selling in gold. And then those are the two common pieces. And then there's one uncommon piece that's really interesting to me. And that is in Texas, in addition to these precious metal legal tender laws that have been passed, Texas has created its own state-owned bullion depository. It's called the Texas Bullion Depository. And their purpose is to develop something to the effect of a state level Fort Knox. So when I was Mint Director, Fort Knox came under my jurisdiction for oversight. And that's where at least half of our nation's gold reserves continue to remain in Fort Knox. And the Texas Bullion Depository was created by Texas, not only so that Texans can keep their gold in state, instead of in a depository in Delaware or New York City, so it's closer to them. But also Texas wanted the option of, as they operationalize Article 1, Section 10 of the Constitution, they wanted the option of having their own depository where Texans can deposit their monetary gold. And Texas is currently exploring how they can use that depository in a way to provide a payment mechanism that's a lot easier than some of the other ones that these other states are using.
So you mentioned these developments are exciting for you, and it's pretty clear that you're excited. I think this would be exciting for many of our audience members as well. So probably the important question to ask is, to what extent can we see these movements being implemented as we move forward?
You can expect more than this legislation being passed, because it already has been passed. The 12 states that I mentioned all have passed legislation at various stages, including one or more of the various things I discussed. So it's already becoming reality, with another half dozen states considering legislation or funding feasibility studies. So it's not been lost on me that these states have moved in this area after the financial crisis. And I think what this does is it indicates, to some degree, there are certain citizens and states that are questioning how the federal government has handled monetary, meaning Federal Reserve money supply, expansion, contraction, printing money, monetary policy, and fiscal policy, which is government spending. This is the government budget, social programs, foreign policy, Medicare, Medicaid, etc. These citizens have been alarmed that the government has basically opened the spigot, and the spigot really hasn't been turned down since the financial crisis. And so I think it's part of this is citizens wanting private sector, not more government alternatives, but private sector alternatives like gold, silver, and even cryptocurrencies like Bitcoin. I also think this is also in conjunction with new technology, like what I talked about, Valaurim's ability to make really tiny amounts of verifiable gold into a large enough physical presence to be practical. And so some of these states, for example, Utah and Nevada, not only have they made gold and silver legal tender, but they basically said, we're going to let the private sector figure out how to operationalize this. And on a voluntary basis, people have bought and accepted gold notes made from Valaurum as legal tender. And so Valaurum was able to make a note with as little as 1/1000th of an ounce in it, which is roughly $2 worth of gold. And so if any of the viewers want to research this more, you just look up Utah gold-backed note or Nevada gold-backed note, and you'll actually see these being used in everyday commerce.
Really interesting again. And this really ties into the last point I wanted to make, which was during the time we had Donald Trump as president, one of our most popular articles on our sites around gold was about if he would bring back the gold standard. And obviously, at this point, we know that that didn't happen, but it was really interesting to see that level of interest. And I was going to finish up by asking if you think that we're starting to, or will continue to see more concern from the American people about the monetary system, and it sounds like everything you're saying points to yes for that.
Charlotte, that's a really good point, and I'm actually not surprised that that was one of your most popular articles. I think what we're seeing is the emergence of two different Americas. And what we have just recently talked about, these 12 states that have made gold and silver legal tender in those states, you're seeing the rising of a number of people advocating for what we call sound money, which is a nicer way of saying gold standard. And that is that you have citizens that believe that if money actually meant something and was tied to something that had value, that would act as a brake and a conscience to all this historic amount of federal deficit spending and very loose monetary policy that we've had over the last 15 years. And part of the fear is it's creating unprecedented federal debt. We're racking it up at $1 trillion a year, which is about 25% of the total federal budget. And we've needed historic amounts of US dollars in order to fund all these various things. And there's a real worry that eventually, if the economy bounces back in a really robust fashion, like what the private sector believes in, there's going to be a tremendous amount of inflation. And as a result, you want to get out of dollars and into something that goes up when the dollar goes down, which is why the interest in gold and to some degree cryptocurrencies. So that's one consolidating group of economic policy people that believe in sound money, and that group is beginning to gain momentum. But on the other side, you have what I would call, and they would call themselves modern monetary theory, and these are policy advocates that believe that if people gave up the idea that money should be tied to something and mean something, we could print unlimited US dollars and basically spend our way into a new era of economic prosperity where we could provide free education and guaranteed minimum income for everyone not already gainfully employed. And what you're seeing is the front end of that in this current administration, beginning to talk through these ideas and having these ideas seep into the policy decisions that they're making. The problem is these two ideas are incompatible with each other. And it's one or the other, but you can't have both. And right now, the world of money and value is leaning toward going down this road toward modern monetary theory. So, it's a brave new world that we're headed into. It's an experiment that only comes along a couple times a generation. Roosevelt did this by taking our money off the gold standard. And then we had the financial crisis in 2007 and 8, which we had a chance to explore this. And now we have it again. And so these chances only come around once in a really long time. And this is a chance for modern monetary theorists to kind of put some of this into practice. And then we're going to be living the consequences, either good or bad, after this.
All right. Well, you've given us so much to think about. I think that's a great place to wrap it up. But thank you so much for coming on. It was great to hear your thoughts on what's going on in the gold market right now.
Charlotte, thanks for inviting me. I appreciate the really tough questions and look forward to doing this again.
Yes, hope to have you back soon. And once again, I'm Charlotte McLeod with the Investing News Network. This is Ed Moy with Valaurum and formerly of the US Mint.